Today, we are taking a deep dive into what is really happening to the foundation of digital money. Because right now, looking at the charts, Bitcoin seems totally boxed in.
Yeah, completely stuck.
Right. It is consolidating your $62,800, basically caught in this massive tug of war.
Absolutely.
But while the market obsessively watches that price action, we want to find out if this is just, a temporary liquidity squeeze, or if the entire architecture of global finance is being quietly rebuilt in the background.
Well, the daily price movements are definitely distracting us from that massive architectural shift. But to really understand that long-term shift, you have to untangle the immediate short-term stress first.
Right. Let's start with that immediate stress.
Yeah.
Because the mechanics are just brutal right now. I mean, trading algorithms recently forced a wave of liquidations, right?
Oh, ruthlessly. They pushed the price down to $61,871.
Simply by forcing traders who borrowed money to sell their positions. And on top of that, there is a $10.6 billion options expiry looming over the market on June 26th. Is that massive deadline what is keeping such a tight lid on volatility?
It acts like a heavy blanket on the price, absolutely. But, the more concerning mechanism here is the severe capital flight.
Right.
Just look at the U.S. spot ETFs. I mean, they bled $6.35 billion over just a 30-day window.
But wait, BlackRock confirmed that a huge wave of capital is rotating directly into the AI boom right now.
Yeah, they did.
So isn't this just like a standard tech sector rotation? I mean, investors chasing the shiny new thing doesn't necessarily point to a fundamental flaw in Bitcoin itself.
It is super tempting to brush it off as a standard sector rotation, but the broader macro environment tells a much harsher story.
How so?
Well, this isn't just about AI. Bank of America is forecasting a surprisingly aggressive path for the Federal Reserve. They are predicting 3 consecutive 25 basis point rate hikes in 2026.
Oh, wow, meaning the cost of borrowing money gets significantly more expensive.
Exactly. And you have to look at how that actually functions in the market. When risk-free interest rates go up, safe investments start generating real yield.
Which acts like a giant vacuum.
Right. It naturally drains capital away from zero-yield assets like Bitcoin. Capital isn't just chasing AI, it is fleeing zero-yield environments entirely.
Because holding money is just getting too costly.
Precisely.
So if the macro environment is actively draining liquidity and money is getting more expensive, what happens to the massive corporate whales? The ones who borrowed billions under the assumption that credit would stay cheap forever?
Things get very difficult for them.
Because I'm looking at Strategy Inc., and they seem to be hitting a very hard mathematical wall.
Yeah, they really are.
They issued this STRC preferred stock, and suddenly their required scheduled cash payments, their dividend liabilities, exploded to $1.2 billion.
It's massive.
And their cash runway collapsed from 7 years down to just 14 months. I mean, this sounds like taking out a massive variable rate mortgage just to hoard gold. Does this debt finance treasury model have a fatal structural flaw?
The flaw lies in the friction between two totally different financial systems. I mean, crypto markets operate 24/7.
Right.
They never sleep, and the asset valuations fluctuate constantly. But servicing traditional fiat debt requires real-world scheduled cash flow.
Because the bank still expects cold hard cash on the first of the month, no matter what your crypto portfolio says.
Precisely. You cannot pay your real-world corporate dividend liabilities with paper gains in a digital asset.
That makes sense.
The model is brilliant when credit is nearly free and asset prices are soaring, but the moment liquidity dries up, it creates a terrifying cash flow mismatch.
So you might be wondering why you should care if a corporate whale over-leveraged themselves. Well, while that short-term liquidity stress plays out, the actual rules for the digital money you hold are being fundamentally rewritten.
This is the part that is really flying under the radar.
Yeah, because the Genius Act is stepping in to grant stablecoins trust bank charters.
Right.
And this effectively allows private stablecoin issuers to completely bypass the strict capital requirements that normal commercial banks have to follow.
Exactly. And simultaneously, a newly passed housing bill explicitly bans the Federal Reserve from creating its own central bank digital currency until 2030.
It is such a wild contradiction. The government is legally blocking its own version of a digital dollar while essentially franchising out the concept to private tech companies.
And franchising it out carries a massive hidden systemic risk to the traditional banking system.
Wait, really? How?
Well, these private stablecoins hold their real dollar reserves in traditional FDIC-insured community banks.
Okay.
If a massive, unregulated stablecoin suddenly fails and sparks a panic, users rushing to withdraw their funds will instantly drain the actual real-world bank's reserves.
Oh, I see.
By socializing the risk, an uninsured private stablecoin run could suddenly leave the FDIC on the hook for catastrophic losses.
So the ultimate takeaway here is that, well, Bitcoin's short-term price struggles against aggressive rate hikes and corporate debt traps. The regulatory integration of digital money isn't slowing down at all.
No, it is accelerating. The entire underlying plumbing of the financial system is being replaced, literally right beneath our feet.
Which leaves you with a pretty fascinating scenario to consider. If private corporate stablecoins completely capture the digital dollar market by 2030, think about the impact. If a developing nation's entire economy eventually relies on a digital currency governed by a Silicon Valley boardroom rather than a central bank, what does that actually mean for global sovereignty? Definitely something for you to think about.